A dollar today will not buy the same value of goods and services in 10 years. This is due to inflation. Therefore, it is important to find the right strategies and investments to hedge against inflation. Hi, my name is Gio. Hope you're doing well. In today's episode, I want to show you my top 6 asset classes to hedge against inflation. Let's get right into it. Inflation measures the average price level of a basket of goods and services. It refers to the increase in price over a specific period of time. As a result of inflation, a specific amount of currency will be able to buy less than before. The US inflation rate reached 7.9% at the beginning of 2022, marking its highest level in 40 years. US core inflation and core consumer price index both topped 6% for the first time since September 1982 as well. It's important to know that inflation affects more than just the price of a consumer goods. Almost every asset class can be affected in one form or another. An inflation hedge is an investment that is made for the purpose of protecting the investor's portfolio against decreasing purchasing power of money due to the rising prices of goods and services. The ideal investment for hedging against inflation include those that maintain their value during inflation or that increase in value over a specific period of time. Certain types of investment increase in value during normal economic cycles but decline during inflationary cycles. For example, an investor may buy an investment with an annual return of 5%. However, at the end of the year, when the investor plans to sell the investment, the inflation rate accelerates to 7%. It means that the investors will suffer a loss of 2%. A disciplined investor can plan for inflation by owning asset classes that outperform the market during inflationary times. Although traditional bonds are the usual investment during high inflation, they aren't the only investment that produce a revenue stream. Here are my top 6 asset classes to consider when seeking protection from inflation. Number 1, we have ETFs and mutual funds. Stocks offer the most upside potential in the long term. In general, businesses that gain from inflation are those that require little capital. When we talk about ETFs, we have to mention S&P 500, which tracks 500 publicly traded domestic companies. Currently, the S&P 500 has a high concentration of technology businesses and communication services. Both technology and communication services are capital-light businesses. If some US companies' earnings are expected to shrink, global international ETFs outside US can hedge predominant US portfolio and bring potential returns from worldwide markets where inflation may not be as high. However, there are disadvantages investing in S&P 500 index. The main drawback is that the index gives higher weight to companies with more market capitalization, so the stock prices for the larger companies have a much greater influence on the index than the company with lower market capital. And the S&P 500 index does not provide any exposure to small capital companies which historically produce higher return. Number 2, we have defensive stocks. The high inflation rate typically leads to rising interest rates that can affect stock market return. Certain sectors act as a hedge since they tend to appreciate in the same time. Materials and utilities are two defensive sectors that investors often rotate into. When the prices of raw materials rise, material stocks go right along with them. Utility stocks typically make stable investment. Demand for utility services tends to remain steady even during a recession. The rates they charge for delivering these services are either regulated, approved by a government entity, or contractually guaranteed. Because of that, utilities generate reliable earnings, enabling these companies to pay dividends with higher average yield. Number 3, we have bonds, including Treasury inflation-protected security. During inflationary periods, investors might consider adding to their fixed income position as higher risk-free returns make bonds more attractive compared to risky assets such as equities. Treasury inflation-protected securities, or TIPS, are a type of US government bonds designed to help investors hedge against inflation. Like other bonds, investors can buy TIPS by lending money to the government. In exchange, investors receive interest. You may also invest in TIPS, ETFs, if you don't want to purchase the individual bonds. TIPS has a fixed rate of interest but adjusts the price's value of the bond based on inflation as determined by the consumer price index. When consumer price index rises, the value of the bond adjusts upwards, meaning investors get more interest and receive more money when they redeem their bonds. These bonds work both ways. However, if we have deflation, the principal amount drops and so does the interest payment. Treasury inflation-protected securities are available in 5, 10, and 30 years duration. Even though Treasury inflation-protected securities may appear like an attractive investment, there are few risks that are important for investors to keep in mind. If there is a deflation or the consumer price index is falling, the principal amount may drop. If there is an increase in the face value of the bond, you will also have to pay more tax. Finally, tips are sensitive to any changes in the current interest rate. So if you sell your investment before maturity, you may lose some money. Number 4, we have gold, precious metals, and commodities. Gold has often been considered a hedge against inflation. In fact, many people have looked to gold as an alternative currency, especially in countries where the native currency is losing value. These countries tend to utilize gold or other strong currencies when their own currency is falling. Gold is a real physical asset and tend to hold its value for the most part. Other tangible assets include commodities such as oil and steel, whose prices not only increase with inflation but also act as an indicator of both future inflation and economic growth. As the economy expands, the demand for commodities heats up, pushing their prices higher. However, gold is not a true perfect hedge against inflation. When inflation rises, central banks tend to increase interest rates as part of monetary policy. Holding onto an asset like gold that pays no yield is not as valuable as holding onto an asset that does, particularly when rates are higher, meaning yields are higher. There are better assets to invest in when aiming to protect yourself against inflation. But like any strong portfolio, diversification is key. Number 5, we have real estate. There are many advantages to investing in real estate. This asset class has intrinsic value and provides consistent income through rent. It often acts as a good inflation hedge since there will always be a demand for homes regardless of the economic climate, and because as inflation rises, so do property value, and therefore the amount a landlord can charge for rent. Because real estate is a tangible asset, however, it's illiquid. An alternative to consider is a real estate investment trust, which are more liquid investments and can be bought and sold easily in the market. Real estate investment trusts are companies that own and operate portfolio of commercial, residential, and industrial properties, providing income through rent and leases. They often pay higher yields than bonds. Another key advantage is that their price probably won't be as affected when rates started to rise, because their operating costs are going to remain largely unchanged. An example of a real asset investment trust with a large exposure to real estate and low expense ratio is the Vanguard Real Estate ETF. Like any investment, there are pros and cons to investing in real estate. First, when purchasing real estate, the transaction costs are considerably higher. Second, real estate investments are illiquid, meaning they can be quickly and easily sold without a significant loss in value. If you are purchasing a property, it requires management and maintenance, and these costs can add up quickly. And finally, real estate investing involves taking on a great deal of financial and legal liability. Real estate investment trusts also have some drawbacks, including their sensitivity to demand other high-yield assets. When interest rates rise, Treasury securities generally become attractive. This can draw funds away from real estate investment trusts and lower their share prices. Real estate investment trusts must also pay property taxes, which can make up as much as 25% of total operating expenses. If the authorities decided to increase property taxes to make up for their budget shortages, this would significantly reduce cash flows to shareholders. And number 6, of course, we have cryptocurrency. those who wish to diversify out of a fiat currency entirely might seek alternative source of value. One emerging asset class is cryptocurrency, including Bitcoin, Ethereum, and other altcoins. As the world's most valuable cryptocurrency, Bitcoin has been one of the best financial assets to own, skyrocketing over 4,700% over the past 5 years, compared to S&P 500, which has increased 113% during that time. The problem is cryptocurrency hasn't much of an investment history. Bitcoin, created in 2009, it's only been actively traded for a decade or so, and inflation hasn't been much of a factor for most of its short life. Even if it may be too early to call cryptocurrency a reliable inflation hedge, this centralized store of monetary value is gaining popularity. Investors can get into crypto by owning coins directly or buying shares in crypto trusts or ETFs. The bottom line is, inflation happens and it's a risk every investor faces. Money tends to lose value over time, and there are many ways for investors to hedge against inflation, including some investments and inflation hedge asset classes designed specially for that purpose. Keeping these assets on your watch list and buying them when inflation hits can help you to protect your portfolio despite the economic climate. Don't forget to do your own research before investing, because nothing from this channel should be considered a financial advice. Let me know in the comments below what is your strategy for fighting inflation. If you are new to the channel, don't forget to smash that like button, subscribe for more content like this, turn on the notification bell, and if you want some free stuff, check out all the links in the description down below. See you in the next video.